Well, Sir Adrian Orr has decreased the official cash rate by 0.5%, and that will have many people getting the party sticks out because this will mean that debt is now getting cheaper and people are going to have more money in their pocket to spend. Now, I'd imagine a lot of you understand now how the official cash rate works, given that it has increased so much and then is starting to decrease and come down the other side. But last year, Sir Adrian Orr told us that he was going to engineer the recession so well that he'd be able to get inflation under control and also start to decrease the official cash rate, and hopefully the banks would pass those savings on to all of the individuals and households who have a form of debt, even business owners as well. Now, of course, the term deposit holders and the savings account holders, they start to get impacted because they can earn less interest on the savings that they have. But let's start to think about what this could mean for the economy. And I believe that there's around $370 billion worth of debt, and around 55% of that is currently in a position where it is floating. So today, a number of those people would have had a 0.5% decrease in their interest cost just like that. And if of course, the bank passes that on, but by the looks of it, a number of them have, from what I was reading in some of the banks that I was looking at. And the rest of them are either they're either floating, so 55% are either floating or to be refixed within the next 4 months, so by 30th of June. Now, what that's going to mean is that there's roughly $200 billion worth, might even be a bit more than that, $200 billion worth of debt, which is going to get refixed or be cheaper than what it is as of today. So that's exciting for a lot of households and will mean that there's a bit of extra money in the pocket for the average Kiwi household who has been getting smashed around by higher interest rates. So what are they going to do with that cash? Well, of course, a lot of people are probably just going to spend it, right? Because the cost of living has continued to increase and things are expensive and their demands might have changed. But, for a lot of us who might want to be thinking ahead of refixing, what do we actually do with that extra money? Do you want to start thinking about clearing down some higher interest bearing debt that you may have? So things that you've maybe ticked up that have become more expensive, and maybe your credit card, is it time to now use the difference to start clearing that? Maybe it's time to pay off your loan faster to keep your repayment the same so that you're not paying the bank interest for as long, or the term of the loan can shorten down because you're willing to repay it back faster. For others of you might want to look at investing and go down that path and learn about that. Some of you might want to build an emergency fund and start to build that buffer and know that with the change in the payment, you're going to use that gap to start put that towards some of your other financial goals. And maybe this has been the wake-up call for you, having higher interest rates where you've gone, you know what, I don't want to be in that position again where I'm worried by not having money set aside and things like that. And so you start to build up a bit of a buffer. But for all of us ahead of refixing, we want to be thinking about what we're going to be doing with the difference in that income. Otherwise, it's very easy for it to disappear. So I think this is a big positive in the eyes of a lot of people. I went through a lot of the monetary policy statements and some of their economic outlooks and whatnot, and I guess all of those graphs and stuff always look just a little bit too pretty for my liking, and that things are just going to start getting better. And we know that that's not really how an economy works or what happens, and there's always shocks that are weaving their way through it, and it's very hard to predict what is going to happen. So as always, I think we all need to stay on our toes, but there is some confidence coming through from the Reserve Bank that they believe that the official cash rate could be down by towards that 3% mark towards the end of 2025. Now, there's a long way to go, and there's different things happening around the world, and we don't know, but they're still telling us that they expect it to be trending down. Now, someone asked a question to Sir Adrian Orr, why is it not at 3% already? If you think you're going to get there, why don't you get there and go for it now? Now, I was asking a similar question on the way up. I'm saying, well, why don't we just punch it and get it there faster? But that's not really how they do things, and it is a bit of a slow and steady approach. Now, the answer that he did have, though, was that they believe that onshore inflation, so domestic inflation, is still a little bit sticky, and they would like to see that decrease. Now, if you go back a number of years, I used to read in the comments on Instagram, and you would read in the media as well, that inflation's a global problem. It's nothing to do with what's happening in New Zealand. It's a global thing. Get over it. Don't worry about it. It's not that scary. It's not that big of a thing for us to be too concerned about. Okay, well, now the tune has changed a little bit, whereby domestic inflation, onshore inflation, which is nothing to do with what's happening in the world, is still here and is sticky and is outside the range that the Reserve Bank would like to see it. So that is quite interesting, but I think that narrative changed as inflation become, not just a global issue and not transitory and here for longer, and really caught a lot of people by surprise. So hopefully, people have been able to weather the storm and get through this period. And for some of you who may be in business, hopefully your interest rates decreased if they're floating as of today by a little bit, and that adds a little bit more profit to the balance sheet, to the profit and loss, and you can start to build some more profit into the business and build up that balance sheet as well. But remember too, if you're going to be going to the market for debt soon, whether you're in business or whether you are a homeowner or in a household, the competition for debt is going to increase as well, because a lot of people are out of the game and they can't be borrowing because they can't service the debt. They might be unemployed, they might be thinking about leaving, they might just not be in the game because of their losses in their business, for instance, so then the bank aren't willing to lend to them. So if there's less people to lend to, what do you think the banks that like to make a big thing called profit profit are going to do? They're going to compete harder to win share of the debt. So don't be scared to ask for a deal. And don't be scared to use, a mortgage advisor to ask them, okay, what could we be doing? Do you need to stay loyal with your bank? Realistically, do they really care about you? Or could you move between banks? Or is the relationship that strong that you think you can't change? But, don't be afraid to actually ask to be looked after in an environment like this, because if you're a good customer, a bank is going to want to look after you to secure you, because the lifetime value of you is a lot of money. So make sure that you're bold in the actions that you're taking and the knowledge that you have when you go into those situations. And what else have we got? That's about my take on the whole thing. And hopefully interest rates do continue to trend down so that we can start to see a little bit more growth into this economy. But I think there's still some pain bubbling underneath the surface. But at least Sir Adrian and the crew stuck to what they said that they were going to do, and I think a lot of people had a lot of confidence that that was what was going to be seen today. Now, I guess the biggest takeaway for us to all think about or remember is that as interest rates increased on the way up, a lot of people took time to roll off the interest rate that they'd set in a low interest rate environment before then having to fix to something higher, and then got that big shock and had to adjust their life. Now we've had a lot of warning that interest rates are going to decrease. So people have been fixing for a shorter amount of time, or even floating, going, nah, I'm going to wait until this next OCR announcement. I know that these things are decreasing. And I even saw someone today that said that their floating rate is now cheaper than some of their fixed debt. So now that fixed debt is going to roll off onto a cheaper rate, and they're going to be left with extra money because they don't have to pay as much in interest. So if you think about that at scale, for a lot of people, I think we're going to see the effects of the decreasing official cash rate rolling into the economy in the back half, especially that final quarter of the year. And I know that can feel like a long way away for a lot of people, but if you think about it, if there's that much debt that is going to end up on a lower rate and rates are going to continue to decrease, the expectation is that interest rates are going to decrease, so people are fixing for shorter, and then when they roll off, they're getting a cheaper rate, and then they're ending up with a little bit of extra cash, and then they get to decide how to spend that. So business owners are going to love that, and some people are going to use that to clear debt and to do smart things, but a lot of people will just spend it into the economy and go back to some of their old ways. But let's watch this play out. That's about my take on it. Love to know what yours is. Let us know below.